We start today's market talk. The most unlikely things happen all the time, and the most certain things fail to happen all the time. Despite everything going wrong geopolitically, oil prices up, bond yields up, dollar index up, rupee depreciating, and still stock markets are up, and the markets are not behaving the way people anticipate them to behave. The prospect of higher returns increase with added risk, but so does the variability of returns and prospect of loss. Knowledge of future directions of economies, interest rates, stocks, etc. is essential for investment success. Market setup, as I see it, what should investors be concerned about? Israel-Gaza war or the rise in US bond yields? So, which is the bigger danger to equities is not very clear, while Biden's trip to Israel confirmed that US will not stop Israel from bombing the civilians. And the result is oil and gold prices are up. Now the impact is higher oil prices would increase inflation, which may force central banks to tighten further, thus increasing bond yields. Powell said that higher bond yields are because investors want more compensation to hold long-term paper, though he said that rising yields are tightening financial conditions and doing Fed's work. Now that remark led to the markets going up, but now again the markets are correcting. This conflict will test the resilience of Indian rupee also. Indonesian central banks unexpectedly raised policy rates to defend its currency in the last week. So the India's domestic bond yields have also firmed up and taking cues from the rise in the US Treasury yields, and this aspect has to be also kept under consideration. The slowdown in global growth is easily seen in the result of IT services firms. Now we had discussed about HCL Tech and TCS and Infosys. Wipro had a revenue decline and a margin decline, while LTIM, Larsen and Toubro and Mindtree combination had a good show. Revenue growth supported by key verticals and geographies, 1.6% sequential growth and constant currency year-on-year growth of 4.4%. Good order wins of roughly around 1.3 billion in this quarter. Attrition is declining. FY25 expected EPS of around 200, so we can safely give it a PE of around 25 to 30 times. So that's why it can go up to from 5,500 to around 6,000 level. Q4 EBITDA margins are expected to be 17 to 18%, and merger objectives are playing out. Q2 results of both HUL and ITC raise questions about the robustness of consumption demand. HUL's sales grew by 2.5% in volume terms. The value sales grew by 4%. They are facing big competition from smaller players. ITC, the cigarette business revenue growth was around 8.5%. FMCG revenue growth was around 8% and hotel business grew 20%, while agri business was negative and paperboard was also negative. Agri division was impacted by a ban on rice and wheat exports. At FY25 EPS of around 18, uh, it can easily trade at a PE of around 25 to 30 to the levels of 480 to around 540 in next 1 year. Gross margin pressure continued with DMart reporting a marginal decline of 40 basis point year on year. it is facing a margin pressure in Q2. Revenue grew just 19% year on year, but gross margin declined by 40 basis points. Share of general merchandise and apparel declined. It's a high margin business and it declined to 23.2% from 24.8%. Net profit was lower 5.5% Q on Q and 10% year on year. Drop in consumer discretionary spending was also seen. Stock is at 69 times FY25 expected earning and very expensive. At presently FY24 expected EPS of around 44, it is at 89 times. Hence, people have to be cautious with this stock and it has to correct substantially before there is some value which is seen. There is a huge skepticism about Bajaj Finance ability to maintain the asset growth rate on a huge base and the sustainability of return ratios in the long term. Bajaj Finance had a solid loan growth, asset quality is at its best, net profit rose to around 28%, net interest income rose 30% year on year. There was a good traction due to capital raising plans of around 10,000 crore, so which will result in increase in book, which will give higher valuation. It has an AUM of around 2.9 lakh crore, year on year growth of 33%. Margin will come off, but the concern is margins will come off in FY24 and guidance is of asset growth of around 25 to 27% and profit growth of 23 to 24%. So presently it is trading at 5.8 times FY25 book, which is very expensive and leaves uh, no scope for further price improvement in the stock, and that is why the stock corrected after results. Data Patterns is an interesting stock. It enjoys strong competitive edge in defense electronics and systems. It has shown strong earnings, order book, capacity expansion, and pipeline for domestic defense orders. It supplies critical electronics for radars, missile subsystems, fighter jets, etc. Q1 FY24 it had 31% increase in operating income and EBITDA, 81% increase in net profit. Its FY25 EPS is around 50, so at around 40 times it is reasonably priced at present because of the growth it offers. Improved product mix, lower commodity prices, and higher forex realization aided Bajaj Auto's performance. Bajaj Auto's Q2 results are better than expected, gaining market share in premium segment, scaling up EV business. Apart from Pulsar, launch of Triumph is giving it foothold in 250 to 500cc category. Chetak two-wheeler and electric three-wheeler. Chetak, just for your information, is also electric vehicle only, are in the pipeline and likely to be introduced soon. And it has adopted a revised dividend distribution policy, and the stock price improved in the last week because after the results. Let's see certain technicals. This is US 10-year yield, a weekly chart. The yields went up and touched nearly 5% last week, and it's on an uptrend. Excuse me, and is trading much above its 20 and 50 DMA, and it's expected. Some analysts are expecting it to reach around 7% also. So this is one issue which has to be kept in consideration. And simultaneously, the Brent crude also spiked and has now safely crossed that 90 level or the 20 EMA, and now it is heading towards 92, 93. And what happens now in this Israel-Gaza conflict will decide what is going to happen with Brent crude prices. The gold prices had a breakout. This is a daily chart, and now it is heading towards 2000 level. After the conflict only there was a breakout, though it had gone to a lower level of around 1800. Dollar index is strong. It is heading towards that 106, 107 level, and it can shoot up from there. It is trading above its 20 EMA. So this has to be watched. The complete rally in equities was predominantly based on decline in dollar index in first in March and then in June, July, based on the declining of yields and lowering of or halting of the interest rate cycle. But now people are expecting one more interest rate hike uh, as the economy is strong in the US. S&P 500 is a daily chart. It has dipped below its 200-day moving average, and the Friday's candle was definitely below the 200 DMA. So, if it sustains here or below these levels, then it will get into a bear market. India's 10-year yield, as I discussed, are now heading above their 20 EMA and have now reached the 7.365 levels and are looking strong, but it is still there. It is still not touched the high of around 7.6 odd, which it made in April odd, from where the in 22 where the interest rate hikes started by the RBI. So one has to keep this under consideration. The USD INR daily chart, if you see, the rupee is depreciating and looking to break out from a triangle pattern. So if it depreciates from here, it may go to 84 or 85 levels from here, which will be again negative for equities. This is the Nifty weekly chart. So if you do a pitchfork, you will see that the Nifty took resistance at the center line, and now it is looking to take support at the bottom support line and may head to its on the weekly chart head to its 200-day moving average of around 19350 odd, or around the last low which it made around the same levels. But from the weakness otherwise, and if we see the daily charts, it seems that now the Nifty is clearly below the 20 and 50 EMA and is not able to cross the level of 50 EMA, that is of 19600, and Monday gap up may take it to 19400 odd levels. So after that, this low which was made last week of around 19350 should be watched very carefully. It seems that Nifty is heading to 19200 or 1900, 19000, 19200 or 19000 area. Most indices, as I will show you, are showing a consolidation pattern. As long as yields are up and the dollar stays up, uh, it is difficult for the Nifty to move higher. As I showed you for the rupee, the triangular pattern breakout implies further weakness in the rupee. The only good part is that the SIP flows of $2 billion, that is 16,000 crore a month, are making a big difference to continuing weakness posed by FI's withdrawal, higher US yield, strength in dollar and FI's outflow, and movement of rupee relatively. So these things have to be watched. Price action will be the final output of all these considerations. Now we'll see the Nifty option chain. If you see the Nifty option chain, the on the call side, the maximum open interest is at 19600 with a premium of 660 rupees. So roughly 19650 should act as a resistance. But if you see here, people have added open interest, that is written calls in the money also at 19500 and 19550. That means there are a lot of confidence and that markets are unlikely to go up. There is a call writing at 19,700 and 19,800 and subsequently higher levels up to 20,000 and above. So the people are looking for markets to go down. On the put side, the maximum put writing is at 19,500, uh, where with the 81 point premium. So this is the support, and these guys will also move out once it opens at around 19,420 levels. So they would be forced to cover. So it is looking weak. Now let's see the uh, total OI. It's higher on the call side, roughly 22 lakh contracts, and for put side it is only 17 lakh contracts. So the put call ratio has now comes to around 0.77, and once it goes below zero point 0.7, then the markets becomes oversold. We will see the Reliance chart, which is the one which is causing the basic weakness in the Nifty. Now the Reliance is clearly below its 50 EMA and 20 EMA, and it has taken support at around 2300 levels over the last month or so, complete October. But it can head lower also to, because it made a low of around 2000 in the month of March. So watch out for this. So if it heads lower, then it will correct from here, and then it will take the Nifty also down. Nifty Bank, if you see, is relatively a weaker chart. On the weekly chart also, it is trading below the 20 EMA and heading towards the 50 EMA. And if the Nifty Bank remains weak, Nifty cannot go up. Here again, the results have not been able to enthuse the Nifty Bank, and it had a weekly red candle in the last week. So where it dipped below the 20 EMA on the weekly charts. On the daily charts, if you see, it has taken support at around 43,600 for the last two trading days, and it seems to be holding down. But if this support is tested, it may also break, and then it may first head to the test the 200 EMA at 43,269 or levels, and then may head lower. So this is the one which is supposed to be kept in consideration. The Nifty Bank was able to take support at 43,600 because HDFC Bank had green candles on the last two trading days and seems to be taking support at 1500 level. So this one has to be seen. It will only become strong once it crosses 1540 and 1570 levels. So it should trade above that. Otherwise, it will remain weak. ICICI Bank, it came out with results on Saturday. Results are in line. So presently, the stock is looking weak and heading towards 200 EMA, where it took a support last to last week. So in case it bounces from this 925 levels, then it may head higher. The first resistance will be at around 950 levels, which is the 100 EMA. The Nifty PSU Bank Index is again from its rise. If you see the retracement level, it is now retracing from its all-time high and looking to test the 61.8% retracement level of around 4826 from here. It is now below the 20 EMA on the daily chart, and the price action on the Friday was weak, and it may either head to the 61.8% retracement level of 4826 or to the 50 EMA of 4900. The reason the PSU Bank Index is weak is because of SBI. This is the daily chart of SBI. Now it is clearly below the 200 EMA of 571, and it may take support where it took support in the last 3 to 4 months at around 550 plus 550 odd levels. So these are the levels to be kept in consideration. If it goes down, then it may head lower. Nifty PSE index has now also, though it was going up and doing well, but now it is also correcting as certain stocks among the public sector enterprises are now losing momentum. It is at on a daily chart. It is at poised at its 20 EMA. So let's see where it goes from here. It may bounce back from here next week in case there is a strength in the public sector enterprises stocks. IT index, because of the results and their reaction now, it's on a weekly chart, it closed below the upper trend line and it is looking weak, but it has got these 20 EMA and 50 EMA on the weekly chart which are available for supports. The large cap IT results have been slightly underwhelming, but that was expected, and the guidance has been okay. So let's see if they can take support at these levels. BSE Momentum Index also the rise has been halted and it is consolidating, but it is clearly on a weekly chart above the 20 EMA. So there is a hope for all these momentum stocks here. The BSE Midcap Index on the daily chart is now come below the 20 EMA, and the Friday's fall was big on the mid-cap indexes and a lot of mid-caps corrected. So now it is below the 20 EMA. And look at 50 EMA for the support now. It has had a continuous rise since March and now it is giving up those gains. So most of these stocks have on these indices, mid cap and small caps, have had 30 to 50%, some 100% returns in this last 6 to 7 months, and they will give back these returns. Similarly, the small cap index, it also had a big red candle on Friday, but it is still clearly above the 20 EMA. So let's see if it can take support at 20 EMA. The index which is looking strong is the Nifty Auto Index. Again, it is on a daily chart, it is looking strong. It has broken out and taken support at the 50 EMA and broken out above the 20 EMA, and now it is looking strong. Some of the stocks in the auto index, Bajaj Auto, Hero Honda, uh, TVS, Eicher, Maruti, uh, Mahindra and Mahindra. So all of them are looking pretty strong. Now we'll cover few stocks today. The first stock is IIFL Finance. It's a diversified NBFC engaged in the business of loans and mortgages along with its subsidiaries. It held it had a healthy Q2 FY24, and financial performance is a reflection of the successful execution of its retail focused strategy. AUM grew by 7% Q on Q and 32% year on year, driven by core products, gold, mortgage, microfinance, and digital loans. Growth in non core products also was seen. Commercial real estate and capital market financing, that has remained subdued but is likely to improve by Q4 or so. Steady 4% return on assets and 20% return on equity in Q2 FY24 is a very good return ratio. The calculated spread improved by 50 basis point Q on Q to 8% during Q2 FY24 from 7.45% in Q1 FY24. Diversified assets under management, steady investment towards franchise build-up with more than 4,500 physical branches and access to funds at competitive rates would help sustain growth momentum going forward. The sequential AUM growth at 7% has been driven mainly by growing focus on high yield small ticket MFI loans and digital loans, and these are fetching 20% plus yield, which is reflected in higher return on assets and return on equity. Now, if you may compare the performance or all the ratios of IFL Finance with Bajaj Finance and then compare the valuations, and then you will see how attractive IFL Finance is. Now here, if you see the income statement, the interest income has grown by 7.2% Q on Q and 31% year on year, while the Bajaj Finance also the net interest income grew by 30%. Profit before tax has gone up year on year by around 29%, and profit after tax has also gone up by 32% year on year and 11% Q on Q. Similar to Bajaj Finance, where the profit growth was again in was 28%. Now the key ratios, if we see, AUM growth is around 32%, similar to Bajaj Finance of 33%. NIMs are improved, have reached 8.1%, have grown year on year by 52 basis points and Q on Q 17 basis points. ROA has now reached around 3.9 and ROE is around 19.2. Both have seen improvement. NPAs are under control and have gone down to around gross NPA at 1.8 and net NPA at 1%. Provision coverage ratio is around 44%. And I was bringing out spreads are around 8%. Spread is the difference between the rate at which they are lending and the rate at which they are borrowing. So that is pretty solid. This is the their distribution. Continued focus is on scaling small ticket loans as reflected in increasing share of gold loans, MFI loans and business loans. So if you see the total percentage wise loans, the AUM share, highest is home loans, then which is pretty protected, gold loans, then again they are secured loans, business loans, microfinance loans, construction and real estate and capital market finance, which is the least. So their AUM is expected to reach, this is in millions, so roughly around 1 lakh crore in FY25, and so AUM growth expected is around 26%, so which is good. And net interest income growth is again expected 20% plus. Operating expenses are expected to be lower. Employee cost is also expected to be lower. Profit after tax is expected to go up around 30% and EPS growth is also around 30%. So these are the good ratios. GNPA's asset quality is reasonable and under control. ROA is improving. Price to earning is for the earnings which is expected, that is EPS around 68, which is expected for FY25. The PE is around 10, which is relatively very cheap, and price to book is around 2. So now these are the that is why if you see relatively, Bajaj Finance is at price to book of 5.8 times FY25, and here it is at 2 with similar growth and trajectory. Let's see the technical chart. It had a rise from March, April onwards, and it has given a 50% odd return, and the last few days it has corrected. So I would this looks very attractive stock. It took support at 50 EMA in the month of September and then has risen from there. Now it is corrected. So at all the major averages, this would be a good stock to accumulate. Next stock is Cyient. It's a technology company that is focused on engineering, manufacturing, data analytics, and networks and operations. It reported a subdued Q2 FY24 services growth due to macro and seasonal weakness. Going forward, the company has guided service revenue growth of 15 to 20% for FY24 with a bias towards lower end of the guidance, and this is the reason why the since they have guided towards the lower end of the guidance to around 15%. That is why the stock has corrected. There are structural tailwinds for the company in transportation vertical led by airlines and defense. EBIT margins to improve by 246 basis points to around 14.9% over FY23 to FY25. It has won large deals in digital engineering and technology business with total contract potential of $51.4 million dollars, and order intake stood at $183.9 million dollars. The company saw three deals in sustainability and one deal in healthcare. Within aerospace, digitalization and advanced technologies are seeing traction. Further, aircraft performance, safety and efficiency, defense upgrades, manufacturing efficiency enhancement, supply chain, aftermarket, MRO activities, and urban air mobility is driving transportation segment. Mining and energy is driving growth in sustainability verticals. It is expected that second half of the year will be better than first half. And debt, that is digital engineering and technology, sustainability, new growth areas will grow while communication had a decline, but EBIT margins will improve. So if you see, uh, it had a 4.7% in dollar terms revenue growth Q on Q and 22% year on year. Same is in rupee terms. EPS has also grown Q on Q by around 3.6% and year on year by 65%, and that is the reason why there was a major upgradation of the stock. So the stock is doing well with the EBIT percentage, which is expected to now has gone up from around 11 or 12% to around 14% and expected to go higher from here. This is the revenue trajectory. So if you see, the revenue growth is now on the upside. The stock was re-rated post Q2 FY23 where there was a steep growth in revenues. Uh, it was seen, but now it is still on the upside now. And you can see the revenue trajectory is higher and is going up every quarter. So from 150 odd million levels, it has now gone to 200 plus million levels. EBITDA margins have dipped on Q on Q basis, but they are still better. And now, as operating leverage is kicking in, it is expected to improve with better optimization and cost cutting. This is the profit and loss account. So it is expected to grow around 20 to 15% over the next this year and the next year. And so the EBIT is expected to be better. Similarly, with profits, it is likely to double from FY21 or FY22 level in FY25, that is over 2-3 years. Same thing with net profit. So the EPS is expected to be around 76 in FY25. So you can easily give it around a P of around 25. So it should trade roughly at around 1700 to 1800, 1900 levels. It's a good dividend paying stock. So that is good. It pays around roughly 50% of the earnings as dividend. Let's see the chart. Now it has constantly traded above its 20 EMA from February March onwards. It had a dip, but then the performance has improved, and then it had straight up. It went up straight into 1900 plus levels in September. From there it has corrected, but this is a stock to be added on all dips. The last stock today is UltraTech Cement. Overall, cement demand in India is strong, and the company expects 9 to 10% growth for the industry in FY24. For second quarter FY24, UltraTech recorded volumes of 26.69 metric tons, up to 15.5% year on year growth, with capacity utilization coming in at 75%. Company achieved a cement margin of 15.9% in second quarter, which should improve further in the coming quarters. The management is confident that by 2028, total capacity would increase to 200 MTPA. Given its pan-India presence, persistent government investments in infrastructure projects, and rising rural housing demand, it could drive volumes higher. We will see that its income statement. So if you see, the net sales have improved quarter on quarter, and this quarter it has improved year on year. Around 15% change has been observed, and it is expected to remain on the same trajectory of around in double digit growth now. Similarly, the margins are expected to also improve. So from 15.9%, it is expected to improve better. Similarly, with the profit before tax and profit after tax, and the EPS is also expected to improve from here. So it had a EPS of around 44, which was improvement over second quarter FY23, and it is expected to have a FY24 expected EPS of around 266. I'll show you the valuation how it has been calculated for this stock. Now let's see the volume data. As I told you, uh, 26.7 million metric tons it had in second quarter FY24, which was 15.5% year-on-year growth, though it was slightly lower Q on Q, but it was as per estimates. And this is the quarter where there are rainy seasons. But first half of FY24 has been better than the first half of FY23. Cement realization is slightly lower. Operating costs have also come down, and EBITDA per metric ton has come down to around 956 from the first quarter of 1018. Though there is a dip Q and Q by 6.1%, but year on year the EBITDA is up 18.3%. EBITDA per ton is up 18.3%. This is how the valuation has been calculated for this stock. September 25 expected EBITDA is around, uh, this is in millions, so 2 lakh 12,183 million. Targeted EV EBITDA level is around 14. So enterprise value has been calculated. Net debt has been added, divided by total number of shares. So the value per share comes to around 10,280. Current market price is 8519. So expect a upside of approximately 20% from here over the next year or so. Key ratios, if you see, the sales growth are expected to be in double digits over the next 1 or 2 years with the push on infrastructure and housing. Operating profits are also expected to grow, and net profits are also expected to grow. Our debt is under control and it is going into negative now, and total debt to EBITDA is under control. Operating margins are improving, and ROE and ROCE are also improving. Valuations are now reasonable, and that is why this was expected. So for FY25-26, it is trading below the 14 levels of EV EBITDA, hence there is some value here. And EV per metric ton in dollar terms is also expected to go down, so it will become cheaper from here. Let's see the technical chart. This stock has was taking support at around 50 EMA constantly and going back up from there, and now on Thursday it had a rise after the results, so it is expected to do well, and at all dips it is a buy, where the moving averages are now 20 and 50-day moving averages are converging. They have done a lot of capex for waste heat recovery plant, cement capacity expansion, and commissioned a 2.5 billion ton per annum capacity plant in West Bengal and Gujarat. So we have seen FY24 EPS of around 266, FY25 EPS around expected EPS around 370. So you can give easily, it can go to around another 1,000 rupees from there here. All India prices saw an upward movement of 7 to 8% in September versus June this year. Hence, it is the revenues are expected to remain buoyant from here. I have finished. We will take questions from